Hello and welcome. Now, if you're a director of a UK company, there's a particular tax rule on the horizon for 2026 that could cost your business thousands if you're not paying attention. Today, we're going to break down something called S455 Tax. It's a topic that catches out even the sharpest business owners. And just so you know, this entire run-through has been put together by the expert tax advisors at Pro Tax Accountant, one of the UK's top accounting firms, to help you get ahead of the curve. So, let me ask you a question. Have you ever borrowed a bit of cash from your own company? I mean, it happens all the time, right? Maybe you needed to cover an unexpected bill at home or just needed a short-term float before a client paid up. It feels completely harmless. It's your business, after all. But as we're about to see, that simple little loan can trigger a surprisingly hefty tax bill from HMRC if you don't handle it just right.
Okay, let's put a real number on this, shall we? Let's say you borrow just £10,000 from your company. If you don't follow HMRC's rules to the letter, your business could be facing an extra tax charge of £3,375. That's a serious hit to your cash flow, all from what felt like a simple, temporary loan. For any small business, an unexpected bill like that can be a real problem.
And here's why this is so urgent right now. From April 2026, the tax rate that HMRC charges on these loans is climbing to a massive 35.75%. Now, this isn't some far-off change. It's literally just around the corner. That makes understanding these rules and getting a plan in place today more important than it's ever been. Stay with me here. This next point affects pretty much every small business in the UK.
So, to make sure you're completely ready, here's our game plan. We'll start by looking at what I call the hidden cash trap. Then we'll define exactly what S455 tax is, we'll look at the ticking clock for 2026, cover some other crucial HMRC rules to watch out for, and then we'll get to the good stuff, how to repay your loan, get your money back, and build your own action plan.
Right, let's dive into the fundamentals. How on earth does a simple loan from your own company become such a big deal? Well, it all comes down to the way your company is structured in the eyes of the taxman.
You see, the rules we're talking about apply to something HMRC calls a closed company. Now, don't worry, that sounds technical, but it's actually really simple. It just means a company that's controlled by 5 or fewer people. The thing is, that definition covers almost every small limited company, family-run business, and startup across the entire country. So if that's you, then this definitely applies.
And who are those 5 or fewer people? HMRC calls them participators. Again, super simple concept. If you have a financial interest in the business, so if you're a shareholder or a director, then you're a participator. And that's the key to understanding why these tax rules even exist.
So every time money moves between you and your company, it's tracked in what's called a director's loan account, or DLA. Think of it like a running tap. If you put your own money into the business, the company owes you. But if you take money out for personal reasons, you owe the company. And when you owe the company money, your DLA is called overdrawn. An overdrawn DLA is the exact trigger for this tax charge. Pro tip for you, keeping a squeaky clean, up-to-date DLA is one of the best habits any director can have.
Okay, now that we've got the groundwork sorted, let's get to the heart of the matter. What exactly is this S455 tax, and why is HMRC so bothered about it? Here's the key distinction that explains everything. You see, HMRC views a loan as temporary. You're meant to pay it back. A dividend or a salary, on the other hand, is a permanent distribution of the company's profits, and you pay personal tax on that straight away. So the whole reason S455 tax exists is to stop directors from taking out never-ending loans as a way to pull cash out of their business without ever paying personal tax. It's an anti-avoidance rule, plain and simple. And this is what it's going to cost you. Right now, in the 2025-26 tax year, the rate is 33.75%. But, as we've said, from April 2026, it jumps to 35.75%. Now, that's not a coincidence. HMRC deliberately links this rate to the higher rate of dividend tax. It's designed specifically to make sure there's no tax advantage to taking a loan instead of a proper dividend. Okay, let's talk about timing, because timing is absolutely everything here. There's a ticking clock, and if you understand the deadline, you can avoid this tax charge altogether. Right, I need you to burn this sequence of events into your brain. You take a loan out during your company's financial year. If that loan is still outstanding on the very last day of your financial year, a clock starts ticking. You then have exactly 9 months and 1 day from your year-end date to pay it all back. If you miss that deadline, bang! The S455 tax is due right along with your regular corporation tax. Trust me, that 9-month window can disappear much faster than you think. Let's make this real. Imagine Sarah, a graphic designer in Manchester with her own limited company. She borrowed £15,000 to help with a house deposit. Her company year end is December 31st. That meant her deadline to repay was October 1st the next year. Well, she got completely buried in client work, the date just slipped her mind, and suddenly her company got hit with a tax bill for over £5,000. It's a textbook example of how a casual loan can create a massive financial headache. Now, you might be thinking, aha, I'll just repay the loan the day before the deadline and then take it all out again the next week. Well, I'm afraid HMRC is way ahead of you on that one. It's a practice called bed and breakfasting, and they have specific rules to stop it. If you repay a loan and then take out a new one within 30 days, HMRC just treats it as if the first loan was never repaid at all, and the tax is still due. You'll want to hear this part. This catches a lot of people out. But the S455 charge isn't the only potential problem here. Taking a loan from your company can trigger other tax issues that you really need to be aware of. Here's where most people get confused. Here's another pro tip for you. Remember this number, £10,000. The second your outstanding loan balance goes over £10,000, even for a single day during the tax year, a whole different set of tax rules kicks in on top of everything else. So if your loan goes over that 10 grand threshold, HMRC sees it as a taxable benefit in kind. This creates a bunch of extra admin. The company has to file a P11D form, then the company pays Class 1A national insurance on it, and you personally have to pay income tax on it. It's a double whammy of extra cost and paperwork that many directors just don't see coming. And that's not all. This next change is even more important. HMRC is getting much tougher on deadlines in general. From April 2026, the penalties for filing your corporation tax return late are literally doubling. Being just 1 day late will cost you $200. And if you're late 3 years in a row, that penalty skyrockets to a cool $1,000. It's a very clear signal that HMRC is expecting everyone to be on time. Okay, we've talked about all the problems. Now for the solutions. And there's some really good news here. If you do get stuck paying S455 tax, that money isn't gone forever. The best way to think about it is like a deposit that HMRC holds on to for you until you sort out the loan. So let's look at how you clear it, and more importantly, how you get that cash back. So you've got a few decent options to clear that overdrawn loan account. The most straightforward is to just transfer the money back from your personal bank account. Simple. Alternatively, you could declare a dividend or a bonus, and instead of taking the cash, you use it to clear the loan balance. The company can also formally write off the loan, but be very, very careful with that one. Writing it off usually creates a big personal tax bill for you, so it's often the worst option on the table. Right, once that loan is completely paid back, you can officially reclaim any S455 tax your company paid. First step, clear the loan. Then, you have a pretty generous window to make your claim, up to 4 years from the end of the financial year in which you repaid it. The claim is normally made on your company tax return, HMRC processes it, and then they refund the money. Another pro tip, the minute you repay the loan, set a calendar reminder for your reclaim deadline. You don't want to leave your own money sitting with HMRC just because you forgot. Right then, let's pull all of this together into a clear, simple action plan that you can use to make sure you stay on the right side of HMRC, especially with these 2026 changes just around the corner. So let's quickly recap your action plan. First, always keep a close eye on your director's loan account. Second, that 9 months and 1 day deadline is non-negotiable. Put it in your diary. Third, start planning now for that higher 35.75% tax rate coming in from April 2026. Fourth, don't fall into the bed and breakfasting trap. And finally, always remember that this tax is temporary and reclaimable. If you just stick to these 5 points, you'll be absolutely fine. Now, before we wrap up, it is really important for me to say that this information is for general guidance only. Every business's tax situation is different, and these rules can get complicated. So you should always consult with a professional tax advisor before you make any big financial decisions. And if you need that expert help to navigate these rules for your own business, please do reach out to the team at Pro Tax Accountant. You can call or WhatsApp them on the number you see here, or you can drop them an email at info@protaxaccountant.co.uk. For a really detailed written guide on S455 tax rates in 2026, check out their blog at protaxaccountant.co.uk. And of course, please do subscribe to the Pro Tax Accountant YouTube channel for more essential updates for UK business owners. Thanks so much for joining us.